In this video, we introduce intercompany investments. Companies often make investments in other companies. Depending on the level of control and the amount of ownership, companies have to recognize such investments on the balance sheet in one of three ways. First, you can recognize ownership in other companies as investments in securities. And the accounting method for how to recognize investments in securities is either the cost or market method. And this approach for recognizing investments in other businesses is appropriate when the company that is investing in those securities has little or no control over the investments. So a typical rule of thumb threshold is less than 20% ownership. So if you're investing in businesses in a way that yields less than 20% ownership over those businesses, well, the appropriate accounting method is usually investments in securities. The next accounting approach for investing in other companies is called equity investments. This is appropriate for when a company has significant level of influence, but not control over the investment. So we're talking about a general rule of thumb of 20 to 50% ownership. The accounting method that's appropriate in that instance is the equity method. So that's the second category. And then lastly, when a company has control, usually we define that as more than 50% ownership of an investment. Well, the accounting method that's appropriate is no longer investments in securities. It's no longer equity investments. It is now consolidation. We're going to talk about each one of those approaches, and we're going to start with investments in securities. So investments in securities refers to the accounting treatment of securities that a company owns but does not wield significant influence or control over. Now, there are three subclassifications of investment securities. So there are trading securities, and this represents securities that are held for the purpose of generating short-term profit. And it applies to ownership of debt or equity type securities. The next category is available for sale securities, and this represents securities that are held without the specific goal of selling in the short term. And so this applies again to either debt or equity types of investments. And lastly, there is held to maturity. Held to maturity is specific to debt securities and refers to debt securities that a company intends to hold until maturity. All three have slightly different accounting treatments. They all fall under the umbrella of investments in securities. So let's just go through each one of these. Now, trading securities, when the company originally makes the investment, it creates a current asset. Again, because these are securities you intend to sell within the year, it creates a current asset. The cash flow statement presentation is under cash from operations. And unrealized gains or losses are going to increase retained earnings via the income statement. So the interesting thing here is if you invest in a trading security, so as the stock, let's say you're investing in equity, as the stock price is going up, that represents unrealized gains or losses to you. Specifically, if it goes up, it recognizes gains. Those adjustments to fair value, not exactly the historical cost principle, but since you own very little of it, GAAP wants you to actually recognize increases in the share price of your investment via unrealized gains or losses on the income statement. So that's going to increase your retained earnings. And the corresponding entry is that that's going to also increase the carrying value of the asset itself. Investment income, so if specifically the underlying equity is issuing dividends or the underlying bond is issuing interest payments, well, that's going to increase retained earnings directly through the income statement as well. So both unrealized gains as well as investment income are both going to be recognized through the income statement. And again, both those items are going to be presented under cash from operations. Now, I should say the unrealized gains, since they're non-cash, that's going to be reflected as an add back on cash from operations, where investment income, things like dividend and interest income, since they're being reflected in retained earnings, they're being indirectly reflected in cash from operations. No adjustment is actually necessary. Now, when you ultimately sell those securities, those realized gains from any gain on sale are also going to be reflected within retained earnings on the income statement. And again, those gains are going to be captured in cash from operations. So trading securities are fairly straightforward. This represents liquid assets, and the fair market value adjustments are represented all via the income statement. It's a little different from available for sale securities. The original purchase price is the same treatment. It creates a current asset, but if you intend to hold it for longer than 1 year, it could also create a long-term asset. The presentation on the cash flow statement of this investment, of this purchase, is unlike trading securities where you see it in cash from operations as an outflow. Here you're going to see it as cash from investing activities as an outflow. So it's the same outflow, it's just classified differently. But here's where the differences begin to emerge even further. Unrealized gains or losses to reflect fair value are still recognized. They're just not recognized on the income statement. They're recognized as other comprehensive income. Investment income, any actual income that you receive via dividends or interest income, just like, there's no difference there, just like trading securities, that will be reflected on the income statement and increase retained earnings. It will also be presented under cash from operations. So there's a disconnect between unrealized gains and investment income. Unrealized gains are not part of the income statement, whereas investment income is. Realized gains, just like with trading securities, are going to be reflected on the income statement. The difference is in the cash flow statement, the presentation for those gains is actually moved not from operating activities, but to investing activities. Lastly, held to maturity securities are usually a long-term asset just because it's going to be held through maturity. And that's going to be classified just like available for sale as an investing activity. Now, here's where it's really different from the other two. Unrealized gains or losses from bonds that are held to maturity are not recognized. Okay? So it doesn't matter whether the bond in the open market is changing its price. The income statement is not affected by changes in market value. And this is consistent with property, plant, equipment, and intangible assets where we're not allowed to really reflect fair market value increases. Now, if you are receiving a coupon payment, that, just like with available for sale securities and trading securities, will increase the income statement, which will, of course, increase retained earnings with a corresponding increase to the carrying value of the asset. It's going to be presented just like with trading securities and available for sale as cash from operations. And then realized gains and losses, just like the other two, are going to hit the income statement. And just like available for sale, it's going to be cash from investing activities. So with that table, you guys have an understanding of how these three components of investment in securities are accounted for.